Welcome, crypto enthusiasts, to the Independent Reserve Podcast. We're joined by industry leaders and experts to keep you informed, entertained, and on top of the latest trends in the world of crypto.
All right, episode 6. We've got the guys from Vikara Capital here today, Luke and Mark. I'll get into your bios in a second, but perhaps I can throw over to you just to talk a bit about Vikara and we can kick things off.
Yeah, for sure. So VCARA is a Web3 focused digital asset fund. We're long only. It's a Cayman structure. Mark and I are based here in Sydney.
Invest in liquid tokens only. So stuff that's in the market, stuff that's traded, stuff we can get in and out of.
Yeah, it's a monthly NAV, so there's no lockups on the fund. And what we're really trying to do is identify tech solutions in the Web3 space that are ecosystems that are actually gaining traction, building their businesses, and ultimately becoming infrastructure layers of the future.
Yeah, awesome. All right, so I'll give a quick rundown. We don't have to keep it too formal today because as we speak today, I know we're going to talk about altcoins, tokenomics, and eventually the meme coin phenomenon that's going on at the moment, particularly on Solana. We're going to have to bring that up. So looking forward to that. JT, obviously for everyone listening, is here as well. And both you guys, I guess, have had pretty TradFi backgrounds. Start with Luke. You've been an analyst forever with Platinum Asset Management, Macquarie Capital, and Millennium Management for a long time. And then now you're obviously a co-founder of Vikara. Mark, you're a research analyst at Vesco as well, but also spent a lot of time with Merrill Lynch, Denham Capital, and also Macquarie Metals, focusing mostly on mining. Did I get all that in?
Yep. So I was just telling someone earlier, I'm really bad at market timing. I started in the year 2000 at the NASDAQ peak. Got an MBA, started basically 2 months before the GFC. And then we started our fund 10 days before FTX collapsed. So it's been...
He didn't tell me that as a partner before we joined, by the way.
So, we've both been at this a while. And really, I mean, we how we came at this, I guess, is just our backgrounds, right? So we saw... I was... most recently, prior to moving to Macquarie, I was at a big private equity group that had a lot of limited partners. And I was through two fundraisers and got to see how those guys invest. And it's quite a process, right? So, with a due diligence process that a pension fund or endowment or a super fund here might undertake, a lot of rigor behind it, right? And, within crypto, often that's not the case. So we were talking, and he was at Platinum, he was at Bally before that, Millennium, those are two of the largest hedge funds in the world. Luke saw the same thing, and we came together, and why don't we try to provide this product to family offices or instas? Eventually, let's not kid ourselves. Pension funds and endowments aren't dumping money into crypto today, and that's probably not going to happen in my personal view until there's a regulatory framework, right? But there's certainly, even some of our investors, or I know our peers' investors are large family offices. There's some people tipping their toe in the water, and we just want to be ready for that. So when we set up the fund, we basically created an institutional framework with leading custodians, leading law firms, 2 out of the 4 big 4 accounting firms we use. So we've tried to basically do that off the bat, and that ties into your kind of TradFi opening. There is we're using that, I guess, May 23 years and Luke 17 years to go ahead and try to create something that people feel comfortable investing in and not worrying about all the other stuff, because there's already, which we'll get to towards the end of this, there's already plenty to consider when you're investing in crypto.
Yeah, and to just add to that, Mark's background's in private markets, predominantly in private due diligence processes. My background, Millennium, I was running capital for them as a portfolio manager, same as Balyasny, but it was all public, global equities focus, right? So management teams are established, boards are there, you've got governance systems in place with all those business models. You have none of that in crypto. And so actually, as a team, what we identified is that Mark does work on people that I just have never had to do, and it's an incredibly deep due diligence process, and actually, combined with the business model, the frameworks, the way that we look at these tokens, we actually have a pretty good understanding of who we're actually investing in and what we're investing in. That's really important. And again, it goes to that institutional process, which, in the liquid fund space, there's only a handful of us out there. There's not a lot of guys. Most of the people we're competing with are retail they're not doing due diligence, they're not understanding these ecosystems inside and out. They've got no concept of valuation typically, and we kind of bring all of our backgrounds together to put that into an investment process that, we're offering clients.
Yeah, awesome. Can you kind of walk us through, or maybe just step through an example about how you sort of assess a particular project, just to sort of see what it looks like?
Yeah, so, the first step is how you find a project. It's, we start at a top-down level and we look for themes, areas with oligopolistic industry structures, places that would be hugely benefited by a decentralized approach, somewhere usually where Web2 businesses have taken control and they've got, outsized margins that you could pass back to a Web3 ecosystem. And then we dig in deeper and we do a bottom up and we understand all of the players in that space across different layer ones into various ecosystems and try and figure out who's actually doing it and doing it well. Then once we identify sort of the handful that are left, you obviously do a deeper dive into the team, into the fundamental data, whether it's via dashboards or kind of, team releases on who's using this, what do the stakeholders look like, who's developing, who's actually building in this place, what kind of capital is involved there. And the duration of what they've been building. Typically, like, we're not a VC fund specifically. We're not here to play the next thing that's hot that, someone, there's other people you can invest in to do that. The guys that want to pick what the future looks like. What we're here to do is just sit here and say, okay, what businesses can we analyze fundamentally today that have had a long enough tenure in this space to know if they're doing good, bad, or indifferent? And we go and do that work to put them in our portfolio. Do some valuation work on the back of it, obviously. We compare it to public comps. We compare it to what we think their market shares look like. What else would I miss?
I mean, he said themes, but we have to use narratives. Can't use themes. It's crypto, right?
It's a crypto word.
So, I mean, when you look at that, when Luke said, we do bucket it. So, look, pick your narrative, gaming, DPIN. We've got exposure, of course, to all that. I think we really, I think those are things that can do quite well. They have done quite well. I think they can do AI, for example, right? Everybody's into AI at the moment. So, we have exposure to those sectors. Now, you asked, how do you, okay, one of the things that is we know there's a lot of information all over the place in crypto. Who knows if it's right or wrong, right? So you have thousands of Twitter feeds you might be following, and how much of that is just garbage or how much of it is helpful. That, and then the same can be said for Telegram, which I largely find as largely a cesspool. But Twitter can be actually quite helpful because the teams, if you think about it from traditional markets, you might get an earnings call once a quarter. And maybe, as a PM, you might meet with a management team and get an update, but they can't really give you information, right? Because there's a lot of SEC. If you're in the States, you got SEC rules here. And so what you can in this bit of the Wild West here, you do get timely updates. You can talk to the management teams. It's a much different due diligence process. And one I think is quite good if you know how to use the information. Mm-hmm. And that's where we're looking to create an edge, right? Because as Luke pointed out, your competition in a lot of this stuff is, whether it's retail or even some institutional capital or larger pools of capital, but it largely is still a retail market.
Sure. And when you guys are out there, I guess, communicating, particularly, I guess, with that more institutional money, and you probably come up against a lot of people who don't quite see the value of digital assets. How do you go about articulating, I guess, the value proposition of the tokens that you found?
Yeah, like you try and bring it back to a real world use case that someone can understand, Like when we launched, we were talking a lot about Helium. Helium's a 4G LTE network. They've managed to convince people to spend $850 million of their own money installing Wi-Fi devices basically all over the States, Europe, and even here in Australia. We can argue a lot about the value of that, whether people use it, the fundamentals behind it. But what a phenomenal experience for people to go through to actually build a place that you can ultimately use a phone on and walk around your city without one of your major carriers getting involved. Fascinating, right?
Totally.
We talk about pre-search a lot. It's a Google search replacement, right? It allows me to see ads that someone's paid for, and I get paid to see those ads, and then I get the same search results I would on Google. Again, people can go, oh yeah, I could do that. That's fine. You're going to pay me to search? Great. It's not a lot, but it's something. We go to Filecoin or, data storage in general, and you say, guys, you currently use Google or Microsoft or Dropbox or one of these guys, and why wouldn't you do it over somewhere else. It's just a fourth competitor in the market. Now, most guys will say, well, why do we need a blockchain to do that? Or like, who cares? Like, I'm happy with Microsoft right now. You know, and so there is still a bit of an information or a reason to change construct there. And the tokenomics, when we're going to get to that in a minute, I'm sure, help people change because they're compensating early adopters to move and to help set up these ecosystems, because it's a chicken and the egg, right? Without enough storage, you can't store data. Or without enough storage, you can't get data storage cheap enough for people to care to move over, right? And that's what the tokenomic models are supposed to compensate you for.
And also, I would just add that it is a generational thing too. So I think with file store, it doesn't matter Arweave, you can, there's dozens of storage solutions out there now. You know, for somebody who's maybe sub 40, who's maybe more or even, you know, younger, that's going to be a digitally native person, it's going to be hard to convince a older individual to move from their Apple iPhone storage or Microsoft or Google or whatever over to this new blockchain solution. In the future, I think it's just going to be part of the repertoire of what you use, right? And I think that's across a lot of different things. We do use storage because it's quite simple to understand for people who maybe have never even looked at digital assets. But yeah, it's a good question. It's not easy.
All right. So I guess what are the sort of most sort of common, like, you know, objections or obstacles you're finding when you're speaking with these investors? Like perhaps that sort of slightly older crowd that hasn't quite wrapped their head around the benefits. Like, yeah, what do they typically say? Look, you know, I can't back this.
I'll just stay in my tech stocks. I'll just continue to invest in the NASDAQ. This is going quite well for me. It's gone well for me for really since 2000 and 2008, really.
But also, I think they see a lot of the headlines that baffle us, right? They see a meme coin go up 1,000-fold, and you know, guys with making a lot of money that really it's kind of made up internet money, you know, and so getting someone's head around that there is fundamental uses for this stuff is the first step, which is, guys, forget about NFTs, forget about meme coins, forget about even this libertarian argument, which is the governments all need to be replaced. Like, forget about that stuff, right? What we're trying to do here is create a layer of the internet that's actually free and open for everybody to use, and there's infrastructure that you can currently own. Like, for example, a lot of guys, if you were to go and pitch them today on what the SMTP protocol is, or the TCP/IP protocol, right? They're fundamental layers of the internet that are free to use and that Web2 is built on to build their businesses, right? If you could go back in time and pitch someone that TCP/IP layer and be like, hey, you can own 5% of this now for a small amount of money, it would have been the same then to try and get them over the line on how difficult that was to understand. So what you're telling me, I'm going to be able to connect all of the global computers together and I can own a piece of that. I don't, like the response would have been, I don't care. Yeah. Like literally, doesn't make any sense. SMTP, why would people not just call other people? You know what I mean? It doesn't make sense. So it's sort of that same setup, except the difference is this time we're pointing at Web 2 and saying these guys control a huge market share with these huge oligopolistic industry structures or margins that they're making. And actually you can get rid of a lot of that because software is commoditized today and you are going to get incentives to make people move from A to B.
Yeah, that's a really great way to put it. You know, we have to get there at some point. Like the whole thing as we speak right now is obviously meme coins, and I guess I want to get your take on it. Not so much which is your favorite meme coin, but do you think like these things in some way can actually kind of help the ecosystem, as it does bring eyeballs to the sector? You know, there's obviously a lot of hot money that runs into just meme coins, but that money does end up going, well, it attracts more talent, attracts people to look at it, attracts, you know, developers to go, hey, there's all this money, liquidity that comes into the system that I can build something for. Or do you think it's more the opposite, where it's just, you know, people see those headlines and go, actually, it's just as crazy as I thought, I'm not going to touch it? Or is it somewhere between?
I don't have a good answer on that. Like, we view it negatively more than anything else because it makes our job harder. Like, I'll never forget, we spoke with one guy looking to invest with us, and he goes, man, I took 10x leverage and I bet on a meme coin and I made 15-fold. And unless you can beat me through time, I'm not going to give you any money. And we sit there and had a laugh because you take a step back and you go, well, good for you. First of all, well done. I hope you did that with a real amount of money and you'll never work again. But for every person that sets up trying to do that, 99.9% of them lose all their money, right? And or if they do it enough through time, they will eventually lose all their money. It's statistically going to happen. The other thing is, like, you can blow a market cap via liquidity up as big as you want it to be, but if you don't have enough US dollars, you know, enable and enough demand to actually get your money and your collateral out of that place, it's just like having a VC mark from 2021 on your balance sheet that's 5 times higher than it's probably actually trading for today, right? Like, that asset value is not real. You'd feel really good about it. And what meme coins do really, really well is they grandfather like equity values or at least this perceived equity value of a lot of people in their brain. They're like, I got $5 worth of Doge sitting on my bank. I'm $5 million. But can you actually get it? Now, Doge is big enough for you to, but these new ones we're seeing coming through, they're going from $400,000 market caps to $100 million market caps. And the guy that's got a $10 million holding there is sitting there going, well, he can't get out even if he wants to. So it's nice to feel like you got $10 million. You ever want to go and try and buy a house with that? It's like you're going to bring down the whole ecosystem doing it.
Well, I think it's rotation too. I mean, how much of that money, I have no idea what the answer is, but how much is this new money coming in versus just rotating from, okay, let's take Solana. We know Bonk, we know WIF. Like, you know, these become quite large. How much of that is, we saw WIF get pummeled the other day when Book of Memes came out. Like, I'd love to look at that chart because I think Book of Memes is now still down and WIF's back, right? Is there a correlation or a negative correlation between liquidity and price amongst these tokens? The answer is probably yes. Like, it is just a rotation game. And, you know, I'm sure there's plenty of Twitter posts that have showed how much new liquidity has come into the Solana meme ecosystem as a whole. But, you know, pick your politician that is this public enemy number one, and there's a meme coin for it, right? Like, can you know, Elizabeth Warren or Cortez or any of these guys, can any of these tokens survive more than, once that liquidity starts being pulled, is there, you know, you and I have talked about one that did come back.
Yeah, exactly.
Right? We thought that thing was dead, and now it's a $100 million market cap. But I think that's more of a rarity than a case for the usual. And we saw the same thing in December. You look back in December, Solana was ripping, meme coins were pumping, that kind of unraveled into January, and now we're back. But yeah, I don't know if this is, I don't know. I'd love your guys' take on what this actually, how long this kind of goes on for, and does this liquidity then make it into projects that have a longevity, right? And I know we've talked a bit in the past about, when you can go build utility into a token like a Doge or a Sheem that were around last cycle. But yeah, can you build one into WISP and will anybody ever use it? And
well, I guess the thing for me, and it's been, you know, I think you guys have described it so well. This is like a private marketplace, but information just flows really quickly so that capital can trade more like a public marketplace. So, I mean, when different projects turn up, is there a negative correlation between, you know, an existing project and something that becomes a market darling or a star very quickly? Yeah, I think there has to be, because the information sources are just so rapid. What grabbed my attention before was when you spoke about tokenomics. And I'm really interested to understand, in this sort of market where, you know, people are speculating so heavily, is tokenomics something that detracts from what people look at? I was in the sense that, you know, it can set a ceiling value of where a token should trade. Does that sort of detract of where people want to allocate capital at the moment?
I don't think it's detract. I think that 90% of people don't care. They don't look at it. But when you go and look at the vesting schedules, for example, right? It's fascinating to see tokens run up into a massive VC unlock. And of course, VCs have one mandate at the minute in their markets to hose out everything that they had in the prior cycle. And they're doing it belligerently. It doesn't matter if it's 10, 20, 30% down, they would just hose the entire thing out. And we see it over and over again. Like, it's one of the big things we look for, and we make sure we've mapped out in all of our holdings. It's like, what is coming up?
And what are the unlock schedules?
Yeah. But,
by the way, as you would do in public markets for equities, like, yeah, it's the same thing.
Yeah, just secondaries and whatever. But yeah, like, we have a laugh about tokenomics. I mean, Render is a good example of a token that's changed its tokenomics, you know, in the last 12 months. And what it went, you used to pay for your rendering services in render tokens. You needed 0.2 or 0.1 or 0.5, whatever the number was, right? They made a really simple change to say, let's pay for it in US dollars. And the reason it's so different is because when render's a $10 token, $12 token, it costs you $10 to do your rendering service if you've got to pay 1 unit. Whereas today it's 12 divided by the cost of that rendering service, and it's US dollars. And so the tokenomics have actually made render able to scale and be worth a whole lot more, because you're no longer handicapped for how high the token gets for use case or your demand on that ecosystem. I think tokenomics is so important, and you look at a lot of old type tokens, they have no management teams, no care about tokenomics because it's all about financial speculation. And if you have financial speculation, the token goes up, and if you don't, the token goes nowhere. But if you go and look at these better projects that are building ecosystems that are now almost self-fulfilling and self-perpetuating because they've got all of their stakeholders that are rising and developing, and they've brought enough people into the ecosystem, tokenomics are the thing that keeps those tokens evolving and getting better, in our view.
Yeah, and I would just add on render, because render is a good example. I mean, especially for people that may not be familiar with kind of how these projects work. Render put out a community vote to change the tokenomics model. There was like the 99.8, 99.9 approval. And that would be similar if you were in a public company and the board decided to vote on something. But here it's the community voting on it, right? As a shareholder, sure, you can get shareholder votes, but to change a part of the business plan, that's not going to happen in a Web 2 construct. Where here, they put something in the community, it changed the way tokenomics worked at render, and it's done. I mean, granted, I think it's done well because it's got the hot narratives, but at the same time, it's just a better project. And it's something that, we, I think we like that business a lot. One thing I'll add is too, we're at the point now in the market where circulating supply versus fully diluted kind of doesn't matter. And you're seeing that again, right? You come out, something will have, I've got a token in mind that it's something that's got a $3 billion to whatever, it doesn't matter. It's multi-billion. And it's got like a $40 million circulating supply market cap. And it's a good project, but do people look at it, I think most people today, especially in a good market, look at the 40 and don't care about the 3. At some point, those tokens will drip out, and does that put a cap on it? If there's enough liquidity coming into the market and the market's strong enough, we saw it in 20 and 21, it didn't matter. Buy the 40, But then as you move into the, maybe a less buoyant market, that fully diluted matters a lot more.
Oh yeah, and just to be clear, we don't invest in any of this stuff. No.
And I would be a much happier seller of the 40 and take the liquidity than the buyer of the 40.
Yep.
Yeah. And but there's plenty of examples of tokens that have come out, say in the last 4, 5, 6 months, that there is a massive amount of tokens that are not in circulating supply today, that the performance has been spectacular.
It's going to be, and to come back to circle right back and answer your original question, I guess, which was, how long does this last? For me, it's really difficult. It's a really difficult question. The tangibility around tokenomics will organically keep interest, I think, in those tokens that consistently perform and really trying to disrupt those oligopoly markets or those significant markets in a Web3 environment. The speculative capital for me is something that can be won or lost very quickly, and I think the faster the money, probably the faster the cycle. Everyone is very well aware that around the 20th of April we're going to see the Bitcoin halving, and I've been writing now for a couple of weeks that I think Bitcoin floats all boats at the moment, where Bitcoin is the market leader. It creates capital for people to give confidence in spanning into mid-market cap and lower market cap tokens. If we see some sort of supply squeeze post the Bitcoin halving event, which seems quite realistic given the amount of ETF flow relative to Bitcoin mining supply, it's going to be tricky for something to stop this market. What other things that could stop this market? For me, an ETH ETF might be interesting. We'd probably see a lot of substitution between Bitcoin ETF buyers and reallocation into an ETH ETF. And then I think what might happen quite abruptly is a stop to some of this speculation. If there's enough active liquidity around for people to move from a traditional financial marketplace into crypto-specific assets, and they can do that in places in which they're really comfortable. But perhaps a lot of that speculative capital also dries up under that environment.
Yeah, look, I think we're most focused on the Fed, to be honest. I mean, like, we started the year and the market in January thought we were going to have like 6 rate cuts in the US from 5% down to a 3 handle somewhere there, right? Like, I think with the last 2 CPI prints that we've seen, a lot of the PPI data, like, Fed might do 0 this year. Like, it actually looks that there's, a pickup in inflation. Now, we're not believers that there are, but the data right now is not showing that it's dropping off or that we're back at their 2% number. Now, the market expectations have gone in the last week from 4.5 cuts to 3 cuts, and we need 1 more print and that goes to 0 cuts. And if you're telling me that we're at a 5 and change percent rate, the Fed funds rate for the rest of this year, like, guys are going to get really hurt. And a lot of this speculation out there, like, you've got every asset class at all-time high because the Fed communicated late last year that they'd pivoted. If they come out and they change that, and all of a sudden they're talking about higher rates or the need to control inflation, and I think the halving is a great narrative, and it's worked every other time, but we're very cognizant that it doesn't have to be a narrative that works. It doesn't mean that we go and we put up 5 times our money over the next 12 months. It helps, sure, it's a tailwind. I say to Mark all the time, ETFs work both ways, right? Like, because if tomorrow there's only $50 million of inflows, I think the entire crypto market panics because they go, okay, so we only got $10 billion of inflows. We thought BlackRock was coming. We thought it was going to be hundreds of millions of dollars. We thought it was going to run all year, post the halving. We just don't know. And then the other piece I think that's important to flag is the bigger a BlackRock gets in owning Bitcoin, the more financial derivatives that will come off that. So the options market are just starting up and will begin on the back of that $10 billion ETF. That will damp, volatility in this space because you'll have a lot more people being able to impact it in a much more sizable way in the traditional financial markets. And that means guys will figure out a way to bet against Bitcoin too, which really hasn't actually happened in size in any other cycle. So I think we've been positive all year. We're still positive, but there's plenty of currents that we're watching and we're worried about for sure. Won't find out until
on the Bitcoin ETF volume. I mean, if you believe the stats, I mean, I'm with you. Like, if that financial advisors in the U.S., I think there was a stat, it was $8 trillion of money that could make its way into Bitcoin. Now, obviously, not all, maybe a tiny fraction of that. But if that continues to trickle, and realistically, if you put money into an ETF last week, you're probably not pulling it out there's a period of time where you just kind of let it go, right? So that, at some point, yeah, sure, it may come out. But if that flow does continue, yeah, I mean, all boats rise, right? And in the past, we've seen, when does that, I'm sure we've all seen the charts where it's like Bitcoin goes up, Ethereum goes up, kind of the Solanas of the world go up, and then, the rest of it goes up, right? And people, where are we at in that cycle? It's hard to say how long, because, I mean, again, we've all heard the number of when Bitcoin goes past its previous all-time high, it's another 270 days until the next peak, right? Did the ETF kind of screw that whole thing up? Who knows? That no one's, I'm sure everybody's got a smart answer, but it's hard to say. And the other thing is rates. Like, I mean, the previous cycles, we've been in 0 interest rate policy for pretty much since Alan Greenspan a long time ago. It's totally different this time. And, and to global money supply is highly correlated to Bitcoin's price, I think more than any other asset class. So if all of a sudden we don't have, free money floating from helicopters, like, does that change? But if we do see it and we see lower rates, then it could get pretty wild.
But then if we just take a quick step back, the reason we're interested in projects that have fundamental use cases and adoption that you can quantify is because this financial speculation will come and go. It'll always be a part of markets. That's just what happens. But if we can buy one of these these infrastructure layers or these tokens that we find great value in, over the next 10 years, we're going to have cornerstone positions in infrastructure that quite literally will be the backbone of the internet. And that's what we're trying to do. And so, you know, like I personally find it fun that every 4 years in crypto to date, there's been this 18 months up, 2 years down. Everybody's willing to give back 80% of their gains every single cycle. And that just, I don't think will be how this space plays out through time, particularly now that there's more sophisticated capital coming into the space, because, you know, BlackRock won't let Bitcoin go down 80% next time. They will want to increase their positions. There'll be more guys doing fundamental valuation work like we do.
It's more places to hide, canvas volatility.
Exactly right. You know, and what we're hoping Web3 particularly turns into is the NASDAQ. It's a global capital market that'll allow you to participate and own parts of the internet that you haven't otherwise been able to. But because you're not a regional market, you don't have to just take the US or just take Europe or portions of it or Australia. You'll be able to take everybody within a thematic at a point in time. And so your ability to actually transact on that market is so much broader. So these businesses should be much bigger than Web2 through time. It's our view.
Yeah, I was actually wondering if you could maybe spend a little time just talking about what your view for what Web3 will ultimately look like. You mentioned, you know, the buying some of the core infrastructure for this new world of Web3. But for people who aren't super familiar with Web3, do you sort of want to outline what that is and how we're getting to it?
Like, should I talk about Twitter? Can we just do Twitter for
Absolutely, yeah.
So like everyone knows what Twitter is, or X.com now, okay? X has got 420 odd million users on a daily basis. It's nearly as big as PayPal daily. PayPal's a 90 and change $1 billion business. Elon bought X for 50 odd, plus or minus, right? PayPal charges about 1.5% for every transaction that it makes. And it does it for a sort of select unit of people globally, right? It's not easy, it's not fungible. Elon has an opportunity, if he wants to, and I think he will, to capture the Web3 market and basically create a chat GPT for AI for Web3, in that if he decentralizes the nodes and the infrastructure behind Twitter and he issues an X token that you can fungibly buy and sell, you can tip people with, you can trade in with Amazon for goods that get delivered to your house. He creates the largest payment network globally based on his current active users, and he's got more active users than Bitcoin does today. You know, and so I'll throw it out there and be like, okay, that ecosystem, if you measure it on, you know, any of the metrics to use to value any of these crypto businesses, is the largest token on earth today, literally. And so what does he get for it? Well, he probably keeps 30% of the tokens for himself. He probably forces you to spend $10 a year to buy tokens, and you have to pay to tweet moving forward or to post, whatever it is. And ultimately, advertisers will buy tokens to advertise. They'll pay users directly. Content creators will get their X tokens and they'll be able to swap them for services. He creates an everything app with an everything token that pays for everything. And you basically get around all of the pressures that he currently has from every single stakeholder, whether it's advertisers, whether it's governments. You'll have people that will ultimately regulate and govern a DAO that will allow you to, you know, this is what I guess, what is the sheets, the guys that come and actually post on whether a tweet's real or not. Like, he's effectively going and doing everything. He's sacked all his employees, he's centralized it, he's open sourced all the code, he's setting up all of his payment rails, so he's got payment processing facilities in every state in America. He's basically got it to a point where he's ready to go, and it's just infrastructure. It's just that legislation that needs to change for him to do that. And I think people can understand that, hopefully, that if you had more utility and you could transact on Twitter, people probably just do that every single day. And that's a really good live example, I think, of how you convert huge audiences into this place. And if you get those Twitter tokens fungible and you can buy Doge with your Twitter tokens, Elon loves his Doge, or Bitcoin, or wherever you want to put it, again, you convert an audience into this space that's never been there before. And all of a sudden, you've got 420 million people that are digitally native that are spending out of digital wallets. Yeah, I don't know if that's a good example, but it's something that we see him doing, and you create instant opportunity for him overnight. And he's a 30% holder of the largest transactional payment network globally. Like he becomes the richest man on earth forever, and I don't think anyone, or I find it hard to believe that no one would have already pitched him on that, and that's not what he's doing. What's an example you've got?
Oh yeah, I'll give an easy one, but gaming, like in Web 2 versus Web 3 gaming, which we didn't talk about it earlier and we haven't discussed it, but I've got 3 young boys, and if I let them, they'd play 18 hours a day on Roblox and some other games they probably shouldn't be playing. But they all have in-game currency. And then in-game currency, I feel like I'm always opening my wallet because they always want more, and they've created a bit of it's like a gambling addict who needs more cash. Now, those don't. What I've said to my kids is, what are you going to do? Like, can you bring those with you? Can you go to the next game? No, you can't. Well, at some point, obviously, that those kids, they already are quite familiar with using digital tokens. They don't call them Bitcoin or whatever, right? They just, use them as Robux. But they won't know any other different. They will not know the difference in my view. And I know that's a long way out. 10-year-olds aren't. This is a long tale for Luke and I to be worrying about what a 10-year-old is going to be spending in 15 years. But gaming as a whole, if you believe the stats, 3.2 billion gamers, how many of those gamers would like the ability to play games where they actually own those assets and can monetize those assets and can take those out of that game and to somewhere else? Because it is about, from what I can, I've got plenty of gamer friends and I play a bit, but by no means a hardcore gamer. It's about showing oftentimes like, well, I won this, or I got this, or this is in my bag, or whatever. And I think that's a really easy example for mass adoption, because you already have an audience of 3.2 or 3.5, or even if it's 2 billion, doesn't matter. It's a massive audience. So I think that's super easy.
Yeah. I think even what I even gave this example, Luke, I think I might pinch this one from you. But for example, Googles and the Facebooks of the world, they capture our data every day and they sell it between themselves and other people, and it's worth billions, that market. And if someone came along tomorrow and said, "Hey, look, I've got this token project that allow you to tokenize your own personal data. So if Google wants to use your information, sure they can have it, but they've got to pay you for it." Or or the same thing for Uber or whoever, and said, "Look, if you can take my personal data out of mine, but you've got to pay me for it." I think there's a token that pretty much everyone in the world would say, "Yeah, okay, fine."
100%.
Right.
Yeah.
And then you've got, and that's also a good way to, I always think, to explain it to people going, "Hey, you've got this data. It's just encryption. It's the same encryption that's already used when you log into your bank. It's not, it just allows you to control that. But I guess the infrastructure of how you pass out around that information requires blockchains, really."
Yeah, totally. It's that ownership that's important.
Yeah.
So if you think about what data looks like over the last 10 years, it's your email address, it's your phone number, and that's kind of it. And then it moves to your home address, and then it moves to your retina scans, and then your fingerprints, your voice.
But all the tracking, right? The mobile tracking on your phone. I don't know how I just got a new phone. I had to turn off 50 different things that it isn't going to. And now it asks you, "Can I track you?"
Yeah.
When you first got a phone, no one was asking me, "Can I follow you?" Right? I mean, that's clearly a database of harvesting. Well, that guy went to this shop this morning, then he went over. Oh, he's been to that shop 5 times in the past week.
Yeah.
Hit you up with that, right? Like that, unbelievably valuable information.
The biggest issue with that information is that there's no visibility on who's buying it. And actually, we do know who's buying it. It's the government mainly. All over the Western world, they're one of the largest consumers of our data. And you kind of sit there and you go, well, that's interesting. Like, why on it? Like, I'm boring. Like, why would the government want to care if I get on a ferry at 9:30 or 9:45? It doesn't really matter to them. But the logic and the point's the same, which is I'm happy to sell that data. I don't really care about that piece of my privacy, but I'd rather you pay me than the Googles or the Microsoft or whatever, because if I can get $10 a month for that data, then at least I can elect what I'm willing to share or won't share, and whether the price for that information that I'm sharing is right. So as a great example, everything we sign up to today, it annoys me considerably. You need facial recognition. You need to give your retina scan. You need to scan your face. And why do they want to do that? Like why is it a big deal with 2-factor authentication? Do I need to give them my face for free? And the answer is because everyone else is doing it, right? But guess what? 2 weeks ago, a guy had his face stolen. They put, with AI, a camera that automatically called into his bank and withdrew money, and they nicked $200 million from this guy because he had a face that was public enough that they could actually recreate him via AI and speak on his behalf, right? Think about what you give your phone. You've already given your phone number, your fingerprints, your facial recognition, your retina scan, your voice. Everything's already recorded in data that you've already given to somebody else, and you're trusting that no one will ever get that, so that they can never call your wife on a FaceTime and actually say, "Hey, babe, I'm going to need you to transfer $100,000 to this account. I've got to do X, Y, and Z." Right, that's going to become very common.
My wife and ask me for $100,000. Probably not going to.
Yeah,
that's not what that's going to go through.
Yeah, but the point is the same, which is if you can own that data and you can actually decide whether you want to make that public or not, that's a utility that I don't think is being valued enough right now. And I think we're absolutely looking for opportunities to invest in of people that are trying to solve that dilemma.
Yeah, absolutely. I think I think that the personal data is something that makes directly relevant digital assets, potentially relevant to every human being, and something they'll sit up and go, "Hey, I'm actually interested now because you're talking about me." I just think it's a really good example.
Well, WorldCoin's an example, right? We've kind of been lukewarm on WorldCoin for the example. I would feel like there's an interesting going to certain countries and basically monetizing people's biometric information in areas that maybe they're not Western countries are going to. So we've kind of stayed away from that. But the reality is, think about what database WorldCoin's building. Pretty wild. Gone in everyone for whatever I think it was like, it was $20 and then went up to $200 or whatever as the token went. But I think their payouts went down too. So you basically just gave your iris scan, and what else I of course haven't done it, but what you're giving to a private organization for $60.
Yeah. But 23andMe is the same, right? They go and
I didn't do that either, but
they go and get your blood data, and they've got all of your internal biometrics. The company's worth $200 million, and a private, enterprise could go and take them out today, and they've got like hundreds of thousands. I don't know, I'm making this number up, but thousands and thousands of people's like DNA data.
It'd be millions.
It's millions of people, and you go, okay, what can you do with that? And again, in a really nefarious thing, it's grim what you can do with it. The beauty of, I'd love to know who my long lost grandpa is. I get that's nice, but like ultimately, for $100, I don't want to think about the negative connotations if someone gets that database that shouldn't have it.
Things could get real dystopian real quick.
Yeah,
I feel like we're starting to etch like a James Bond skit of some
bring it back in.
Come through, decides to take everyone out by having everyone's data or something. It's crazy. I mean, there really is a dystopian element to this. I mean, do you guys look for like safeguard? Like, do you guys, when you look at projects, I mean, is the ethical considerations something you look at as well? I guess.
Yeah, of course. Like. I think that it'll.
I mean, WorldCoin is one that I'll just go back to it. We passed on. We saw it early. We're watching it. We've been aware of it, right? But we never owned it for that reason we just described. And to be totally honest, I don't think we've encountered a lot of ethical dilemmas in what we're doing. That's one I pointed out. But like,
what about from an advisory standpoint? So it's interesting. We've had a couple of people call us up and, hey, can you help us? They're more VC style deals. They're equity businesses that you can invest in. Have a look at this business, and you kind of go through and you meet the teams, the management, and their ex-government employees. You kind of look through, I guess, the caliber of people and what they're trying to do, and you hear the pitch, and a lot of it is, we're going to monetize this data by grabbing this and doing this, and we take a look away and we're like, we need to find the Web3 version of this, and we need to understand how they're doing it differently and how they're allowing their users to control that ecosystem. And a lot of our great ideas actually come from understanding what Web2 are trying to do and build, and actually trying to find the people that are doing it in Web3, because it's very easy to understand if it's decentralized properly, if your privacy is respected there or not. But then even still, there's some considerations where you're like, people like even decentralized tokens aren't decentralized often. There's multi-sig, or there's, a select group of small nodes that run the entire thing, keep all the data. And so, we do a lot of that.
Multi-sig with one signatory.
Yeah.
I think to your point, so we've seen stuff where the teams aren't one of the big things I'll say, this is not directly answering your question, but it's kind of like a auxiliary. like if the team's not docs and it's a bunch of, just faces or just no team at all, like we've seen a bunch of interesting projects in the past 6 months that, they've done really well. But if you're not going to put your name and even anything about yourself in your light paper or white paper, which mostly nowadays seems just like fluff, we just won't do it.
Yeah.
So that's not directly answer your question, but I also question why people are unwilling to put their kind of history and bio and names and everything else if they're really backing themselves into a project.
Yeah.
So that's just a non-starter for us.
Yeah, it's really interesting. I think you mentioned before, I guess it's the respect for privacy that probably is the key thing. You can see if your team's respecting privacy, and I guess the good thing about the contracts itself, you can probably see if the contract respects privacy as part of the protocol and all that kind of stuff. Yeah.
But if you're giving someone, $1 million into their business and they're not willing to even, they put a PFP on their...
absolutely. Yeah, like with the teams, absolutely.
Yeah, with the teams, yeah, to his point. But, that to us, that just is a non-starter.
How often does that happen?
Oh,
it's less now, but it's still way too often, right?
I think the projects that are coming to market right now, a lot, because the market's buoyant.
And just people just take advantage of the fact that you can get away with it at the moment.
Yeah, I think even some of these projects that have been around for, they've been developing them for 6 months or a year, and they've raised money from angels or whatever. Like I just find it surprising often that they wouldn't dox themselves. Yeah. And it's almost like a badge of honor in crypto sometimes not to dox yourself. But if you want to move into an environment where, funds like ourselves or just larger pools of capital potentially are going to back your business, I think it's probably not something you can continue to do.
Yeah, absolutely.
Just a yellow flag, I'll put it that way.
But the concept about privacy is funny because a lot of people say to us, I don't care about my privacy. I genuinely don't care that people harvest my data. That's the big...
That's a pushback we get actually from blockchain.
Yeah.
We've talked to guys in the past when don't care.
So I don't care about... What if, using my example before, what if you said, well, do you care about your privacy to the extent that you're not willing to make money off it? Like if you all of a sudden sat and said, hey, you can make money off your privacy, that's the incentive changes, right?
100%. And that's the only thing that's going to get people into Web3 is when that incentive's large enough to go, it's important to me now. I think we saw it last cycle with Axie Infinity. You can argue about that token all you want, but there were people in the Philippines making real money and they actually started playing full time to make that money. Again, through time, I think you're going to have a lot of these platforms where I can do it on Web2 platform A, or I can do it over here and make money doing it. And I think through time, they will do that. Now, here's the thing. So if you think about a Twitter following, you got 200,000 followers, you're not moving until you can get 200,000 people over on the next platform, right? It's just that 2,000 people is your sweat equity that you put in to actually get a big enough voice in the room. It's very similar to the guys that hold the meme coins. That equity that they have on their balance sheet, even though it's not real, that's the equity they've put in to make that ecosystem work. They're tied there forever. And what crypto does really well is it grandfathers equity holdings in for people that Web2 haven't figured out how to do yet. And that's, again, what Elon's potential conversion could be, is that he actually gives you a chance to monetize that 200,000 voices that you're hearing right now or that you've got listening to you to speak to, So
I don't think crypto's cracked the code on social media or just socials in general, these decentralized social platforms. I think there's been lots of tries, but name one that's... there's DeSo out there, but I'm not sure how many people actually use. I think people still go to the Web2, right? Yeah, but still relative size, tiny, right? It's of course it's Instagram or go to Twitter and then Instagram, and the rest of it. Those would have, 10, if not hundreds, thousands more users on multiple basis than anything in decentralized. Now, I think longer term, you need some. But it's also like the music services. Think about Audius as a example. How many artists are on Audius? They have a podcast group. We haven't looked at it for a few months, but it's something that one of those music platforms is probably going to crack the code at some point. But today, at least the ones that were able to buy in a fund, they haven't really done much.
Yeah. Is it just a matter of time until they kind of work out the social formula to move people across? Is it just education going, hey, you move across here?
I think it's actually the talent. It's where the talent starts, because the reason you go and do a deal with Spotify is because they've got 300+ million people there, right? It's really easy. I get a song on and I can take sure, I only get 10 cents in the dollar over there, but I've got 300 million people potentially that'll listen to my thing. Over on Audius, you've got 5 million people, 6 million people, something like that. And so you get 90 cents.
I don't even think,
I don't know if it's active, right?
Yeah.
But that were the sign-ups back in the day, I remember.
But it'd be probably a couple 100,000 active, right?
Oh, yeah, probably, yeah. But you get 90 cents in the dollar. And all it takes is, a Bieber, right, to go and start. And instead of going through the regular channels and getting funneled through into Spotify, they just blow up from that Audius or one of these decentralized, and you rip 20 million people out of Spotify to go and listen to this person's music. If that happens once and you get 20 million people paying 90 cents in the dollar directly to the artist, and the artist can actually use that and funnel that back into more music, more songs to listen to, more people will come, and all of a sudden you've got 50 million people in a decentralized space. That's a big enough audience for you to go after, because all of a sudden you've got 90 cents over here, 10 cents on Spotify. From an earnings perspective, you only need 50 million people, and it's the equivalent of having like 450 over on the other one,
I thought you were a Swiftie. I didn't realize you were a Beebs. Beebs guy.
Beebs? No, I'm just like, he's a guy that, who's the other guy that I'm thinking of? The guy, because Beebs got found on YouTube, no?
Did he? No, wasn't he a Mickey Mouse Club guy?
I have no idea.
I don't know.
So it's Silvio.
What happened to my culture?
I'm not sure. I think he was a YouTube guy.
I thought he was a YouTube.
Was he?
Yeah, I think so.
Yeah.
Yeah, wasn't it?
I'm gonna fact check.
I would fact check that, because I could be thinking about I'm horrible.
You know who
with
was?
stuff.
JT was definitely a Disney guy.
He was a Mickey Mouse guy.
Yeah, was it?
Ian, there was a bunch of them. Like there was him and Brittany. There was another actor, like what's his name? The guy who did the Barbie.
Beale. I think Jessica Biel might have been one too. But
And the guy who did Barbie with Margot Robbie.
oh, the Canadian guy, yeah, who did The Driver. What a great movie, by the way. Anybody's wants to go check out a great movie, The Driver. Ryan Gosling.
There we go. So Ryan Gosling. There you go.
Yeah, there's a bunch of them that kind of got famous at that same time.
Yeah.
Yeah. Anyway, we got off track. I think you wanted to tell us about Taylor Swift.
Yeah. The front row was great.
Nah. You were the one that went outside where they called it Swift. I can't remember the people that go and stand outside the stadium and just listen to it that way. And there's a specific term for it. She's good for her, man. She's created quite a phenomenon. Yeah.
Yeah. No, I'm more of a Fred again guy. We went there on Saturday. He's good God.
Taylor Swift must have the best marketing team. I tell you what, she got across to a decentralized, everyone's getting across. Because, there was such a hype around her. I don't know we should be talking about Taylor Swift, but I have a friend, don't even say like it's me, I was
going to say, his name's Lee.
And he went through, just to get tickets, he went through and he created 20, I think he said 26 different email accounts and opened up 26 different browsers and just sit there hitting them until he got one.
What you do with airdrops.
Right, exactly. But her marketing team they created this almost false sense that you couldn't get tickets before they even started.
Yeah.
And everyone, obviously, she's got a lot of fans and people just went wild. And it's self-feeding. She's on her marketing team. Whoever's running her marketing team, you probably want to steal them for your next gig.
The CIA.
The CIA. We're keen to see cheese.
That's right.
Yeah.
Where's your next, gentlemen? We've got to, I know we've been running for about an hour, but we can't let you go because we did promise to talk more meme coins and ridiculous predictions. Do you want to keep it sensible and talk about Bitcoin and some actual projects, or do you want to talk about your meme coins?
We probably never mentioned that our fund is a non-Bitcoin and Ethereum fund. So, that's interesting. Yeah, that's probably worth spending some time on kind of why we decided to go down that path. And I think it's pretty simple as we saw the writing on the wall. You could own, we launched the fund in, like I said, 10 days before FTX collapsed, so October 22. The Bitcoin, in our view, Bitcoin ETF was inevitable. I already had futures ETFs, but spot ETF to allow the average person to go buy it very seamlessly was inevitable. And I think Ethereum, maybe not in May, but probably happens, and maybe Solana happens after that. But are you going to have 50 ETFs? It's highly unlikely, at least, not anytime soon. And so we wanted to be able to provide use our skills to provide access to non-Bitcoin and Ethereum. So that's pretty much why we went down that path. If you want to talk about, I guess we can talk about memes first, and
what I think what about memes.
What's the what's happening with them, or what is it? How does this end? Does it end
How did I don't know? Like right now, like everyone, maybe it's obviously we live in a bit of a bubble, and everyone's talking about the meme coins and Solana. We have to keep coming back to them. But I'm just fascinated. It's just such an interesting social phenomenon. I think just what makes is, and again, it's probably just simple as saying it's degenerate gambling.
Well, it's public enemies.
Is there something more than that?
It's public enemies too, right? Like, or like, let's just take the Trump Biden, right? So, you had Trump on Ethereum, which was the Trump token, MAGA, and that thing's been out for a while, right? So that actually pumped in December, and then now it's come back. But then they had the Trump and Bowden. I'm sure you know this one. And yeah, totally from Solana has been tweeting about Trump versus Bowden, right? So a guy who founded one of the most successful blockchain projects of all time is tweeting about two meme coins about the president spelled incorrectly with a goofy face that looks disfigured, right?
Yeah.
If someone from the outside looked in would just say, what is going, how is this happening, right? But yet these things, I mean, I think Bowden got up to a $200 million market cap. Or whatever it was. It's no width, but it's still going well. And those things, they have a massive following. Look at the liquidity in these things. Both of them have, I think Bowden must have, multi-million-dollar liquidity. I know Trump's got over $1 million of liquidity. These are things that people are now trying to play for the presidential race cycle. So if you read about them, I'm going to play this through November 24 because this is something I can play and benefit from a presidential race in America. So it's gone from just a piss take to a strategy behind playing these, right? But the characters in the space are feeding into it. Again, totally tweeting about it pretty regularly. I was
going to say, it's just a symptom, really, of a construct in society where boomers have a shitload of capital, and I think a lot of the millennials don't. And, there's a lot of good articles written about it, but it's like millennials have no choice or no other way of making money. Like, if you think about a millennial, 100 grand a year used to be a lot of money 10 years ago. 100 grand today, you might be able to live an hour and a half from Sydney and commute in, if you're renting somewhere. Like, they don't have the opportunity or the deposit to get into the housing market unless mum and dad want to provide them with some opportunity there. So how else do you do it? Well, you sit there and you're like, I'm going to go to work anyway. Why aren't I putting $100 or $1,000 or some number on a series of tokens? Because if I turn $500 or $100 into $1,000, it's material for me, And I think what people forget is this is a hobby for most people. They used to punt on horses. They used to punt in the casinos, or at least people of our generation probably used to do that. The new punt is a real-time market that trades 24 hours a day. There's no rules.
But it's global too, right? So the people you take a look, go look at DEX tools and look at the trades. You'll have a $5 trade, a $3 trade, a $10 trade. And Solana, that's fine, right? Because the fees are extremely low. And so you can churn that over and over again. So it's not just us talking about people in Sydney, right? It's people in India. It's people in Indonesia. Look at the number of crypto owners in Indonesia. About 40% of the population is a crypto owner. So you're now in a global market that looks at 24 hours, 365 days a year, to where you can invest $5 and get out 30 seconds later for $8. Do that, over and over and over again. And that's why people who would say to us, we've had a few people, I bet these people largely died at this stage, said crypto's dead. It's going to go away. This is all a bunch of bullshit, right? I think that's gone. Like I think it's hard now for people to kill this entire industry. But especially because the market participants are so scattered all over the world. Like, good luck. It's not like you can go and just smash the U.S. regulatory environment with some, you can't own crypto or something. It's impossible. It doesn't matter. It doesn't. And Polygon's an example of that. Remember when they were trying to squeeze Polygon late last year? I think it was the SEC. And the SEC said, thanks, but we're a decentralized business. We can, pound sand, and nothing happened.
Yeah. Yeah, exactly. Well, this is the question I'm grappling with, and I think is kind of interesting, is everyone goes, well, crypto's just used for, in a lot of cases, just speculation. Maybe that's true, right? Yeah. Maybe that is true. And it is definitely true, I guess, in a lot of circumstances. But you can't deny the fact that these ecosystems, for want of a better term, or these participants are there. They're real. and
It's a flywheel.
The platforms that are used to speculate on these things are popping up. Now, I'll give you a good example. I mean, you can go biggest, I guess, trading platform in Australia by volume is still probably, I don't know, CommSec, right? But you go and look at CommSec, and that they've had a long time to develop their UI and their platform, and it still looks like you're using Windows 95 or something. And the Dex tools have popped up, and it's doing lots of volume. Sure, maybe, but it's being whipped up by, I guess, who knows by who. But the whole thing is so much more slick and looks so much better, and is so much more intuitive to use. Even if it's just then being used to speculate on meme coins. And I guess the point that I'm sort of interested in going, yes, well, this thing's still real, and these platforms are being built. And if you started then using those platforms to actually trade for things that are more real world, you would have, right?
Oh, seriously, totally. I mean, the people that are doing this right are making a lot of money, and they're getting a lot of money into US dollars that sits digitally. So like 100%, like there's, you can equate it to like a gold rush that used to happen out in Kalgoorlie, right? People would go out there with their measuring tape and say, I got the next 15 feet. They'd dig down, they'd find some gold, they'd become rich overnight, and they'd, there's no different to what's happening here, except everybody's digging globally in a digital kind of realm effectively, right? So, does everyone hit gold? No. Well, most people, like they do in equity markets, lose money through time. Absolutely. And like leverage is typically what kills most people in this space, because you can go and get 19 high times your money, and you can be a genius for 10 minutes and you can be really stupid in 30 seconds, So, no, we're with you. Like, and I guess what we're trying to do within all of this is ensure that our clients get exposure to this gold rush that's happening, the opportunity that's happening, but at the same time, missing a lot of the pitfalls, which is for every one good token you hear about, there's probably 100 that suck. There's probably, for every token that's around for 2 years, there's probably 50 that are rug pulls, or quite literally they rip liquidity and you lose all your money. Like it's almost like a bias that you hear about the one that's just gone up 1 million-fold, and it's that addict's next hit effectively, because my little brother is a great example. He's a child psychologist, lives in regional Victoria, and yet he comes home from his job, he spends 5 hours trawling like crypto chats in Telegram, trying to find a 300 grand market cap that goes to $1 million because it's important to him, and it actually helps supplement his income. He's very good at it, mind you, but you sit there and I kind of hear from him, he's like, dude, you got to get into this thing. And I'm like, first of all, like, stop. Like, how did you get this? Like, where did it come from? But, if he can walk away from this cycle with another 10, 20, 50 grand, whatever it is, and God forbid he goes and hits 1,000x and he actually makes himself $1 million, like, it is so tangible for that guy that I can't discourage him from doing that, even though you can try and guide him on how much risk he's taken to get that return. Yeah.
And so when you think about the portfolio and your portfolio allocation, what does it look like?
It's diversified.
We've got about 35, 40 tokens in there. And it's definitely weighted towards, I want to say mega caps, but, larger mid caps, small caps. And then there's a tail that has, part of the thing is, so we've got certain risk metrics of how we manage a portfolio. No bigger than a 10% position size. That's because we're a liquid fund. If you want your money back next month, you can get it back next month, right? So we have to be very cautious here. But I think that's good risk management anyway, because these things can move so quickly. So, and then within that, we've got liquidity of how much daily traded volume can we get out of a position, right? We don't want to be 50% of a 1 day's volume. And then frankly, that changes over time too, right? You look what, say, last September versus today, it's going to be massively different volumes on some tokens. Then now, most of our tokens, we're fine, right? The size of our fund relative to the size of, you think about the top 20, top 50 tokens. But, we do own tokens that are, sub 500 market cap because we see an opportunity there. So I would say that, and that's part of the edge that we were describing earlier. We want to be able to provide that exposure to those tokens to, frankly, most people are never going to have exposure to that unless they're in this, they've got their own wallet, they're buying it on wherever, Dex or something.
And even then, they don't get any of the security overlays. They don't get someone watching it. They don't have like risk management. Like, there's no audit there. There's so many things I think we've tried to set up. Because most people, there's two things that are going to make you lose your money. You miss the top, if there's a top this cycle, and it just blows off.
I think it's always going to recover.
Right? And you give back 70 or 80, 90% of your money. You get hacked, you have some type of phishing attack, get your wallet. You know, a lot of guys, I just want to say a lot of guys, if you're digitally native, you've been in this space a long time, you know how to mitigate some of that risk. But ultimately, it's one password that someone has to get into your internet extension, and they can do whatever they want. You know.
Like the guy, we were in Dubai recently, and a guy we know, he's been in since 2016 and done extremely well, and all of his USDT just dripped out of his wallet over a week.
Yep.
And like this guy, he would not be the guy you'd expect that to happen to. So it happens to people that have been around for a long time.
Yeah.
Probably, because say you interacted with a contract 3 years ago and a wallet you still have and you're still playing around in that wallet, you never know.
Yeah.
Just waiting to steal from you.
Yeah, and like, well, but like we diversify our custodians like considerably because of that. Like we diversify, or we make sure that we've got governance on all of our wallets to make sure that there needs to be multiples of people in VCARA to actually coercively or get involved to actually move money. Like what we're trying to do is provide a place where you bet on Mark and I to pick the right tokens and to avoid the blow-ups. That's what you're trying to allocate towards, not whether you have your money in a wallet in 3 years' time, or not whether, you know, you have to sort of face off against a hacker that actually knows how to get into your Microsoft, because that's going to be common, you know, like.
But also protect the gains. I think there's not enough time spent. We've been thinking about it. We think about it every single day. When is, like, we may miss the last 20% or 30%, but if, you know, you're slowly dripping out when stuff's going up 200%, which hopefully we're in the face melting gains phase of the crypto cycle. We were doing this not in a fund structure, but we were doing it together in 2021, and it almost becomes a self-fulfilling prophecy. And I don't think we're there yet. Like, you don't see retail come into this in droves. The only wallets that are cranking are Solana right now, and I think that's largely because memes. You get a pretty good vibe for when stuff starts getting really crazy. But even then, guys were saying crypto winter's coming, you know, and yeah, you're not getting any of that today at all, right? Like we've got 18 months or we got 12 months or whatever. So, and again, I think some of this, now put the macro backdrop, which is different this time around. So maybe that does overwhelm, you know, the largely retail market. But if that doesn't, and it kind of just stays status quo, there's going to continue to be, I think, the almost self-fulfilling prophecy of, and your point about the Solana memes, that is a bit of a flywheel, right? Because I've seen some Solana tokens that have nothing to do with memes that have probably benefited, and they're going up at the moment. They really haven't had a dip. They're deep in or whatever. They're probably beneficiaries of some of this overflow of excess cash you made on book of memes or whatever, making
Capital gains being
totally
redistributed.
Just being put into something that's less risky. Yeah, and that's something that's going to give you 5 times, not 500 times.
But maybe to finish that off, like we've spent a lot of time on where we can get this portfolio at the end of this cycle into, you know, 10 vol asset classes that are still digital, that aren't Bitcoin and Ethereum. And this is the whole thing. So like most guys will go into Bitcoin and Ethereum and then they'll ride that down. Or they'll go into USDT, USDC. Now, like the stable coins are centralized predominantly, and so there's always issues there. Now, USDC has proven itself through time that it's actually backed, or at least hopefully. But our whole thing is that we don't have to this time go into just a stable coin and wait. There are other assets now that are being added to the blockchain, like gold, like 10-year treasuries, you know, like bond prices. Like we can actually get access to more asset classes, I think, through time that'll turn into equities at an ETF level initially, or an index level, all the way down to an individual stock, you know. And so through time, this digital asset ecosystem will become, I can trade anything. It'll be a synthetic version of anything in the world. And so our portfolio will naturally de-risk itself through time because we'll have so many more options to go and actually place the capital into.
Yeah, absolutely.
And also just the derivatives market's evolving quickly. I mean, we talked about this last time we met up, right? You now have what's looking more and more like a traditional OTC desks at various crypto groups that are providing opportunities for us to essentially call up and make a market in certain things. And obviously you've got the existing incumbents that are out there. But I think by the time, you know, push 2 years forward, that there's going to be more and more options to be able to hedge your portfolio in a sensible way that you couldn't have done last cycle.
Yeah, absolutely. It feels like the TradFi markets, they're just begging to create like a swap market in almost every digital asset at the moment. And I think as soon as that happens, that volatility really drops, and you're probably going to get quite a organic and normal looking curve for a lot of these digital assets, depending on how they can be discounted and what sort of profile that they might exhibit.
Yeah, well, you get bifurcation in assets, right? Like you'll actually get tokens that have use cases trading better than tokens that don't, and so the next cycle might be a top, but correlations won't go to 1 and everything goes down. Like you might actually get things that hold in and continue to grow because you've got enough sophisticated investors looking at these things and placing real world value on these things too. Yeah.
3 or 4 years ago, I was looking at I was heavily invested in creating a short-term interest rate trading fund, and sat around the table with a lot of different family offices in Australia looking to raise capital, and would have a really similar conversation with almost every one of them. Rates were at 0 at the time, and their question to me was always, how do you beat the Aussie housing market? What sort of return are you going to make for me, knowing that it's an alternative asset? Given that all my capital can sit in the Aussie housing market, and I get some pretty preferential tax benefits for that. I'm really interested, sitting across from you guys, what your answer might be and what the risk premium might be that investors are seeking to allocate into digital assets at the moment.
Yeah, it's interesting. It depends how levered you are in that equation. It depends on a whole host of things, to be honest. I mean, I think globally, most, Fidelity Canada put this out, allocate somewhere between 1% and 3% of your portfolio into digital assets. I think if you've got an established portfolio and you're closer to wealth preservation than you are wealth creation in terms of your allocation strategy, that's all you need, right? You're looking to supplement your portfolio's growth 5-10% annually, and you want to have exposure so that you've got presence and you're not missing it completely. But you're also not here to bet the farm because you're obviously got your asset class is set up or your capital pool set up. Now, if you're in a place where you've got an extreme amount of leverage on Australian houses, I mean, most people make their money, at least initially, on housing because they take 10 times leverage, and they've had a phenomenal series of tailwinds, which is, an 18% interest rate in Australia in 1990 comes down to 0. They've had huge inflows from immigration. They've got a government that continues to print money, or Western governments in general, and it's helped property prices globally. There are a lot of tailwinds that exist behind a really good property investor that is very rarely recognised by a very good property investor. Now, I think Australia does a great job here. Property in Sydney is never going anywhere. If you live near a water, there's a reason that property is expensive, and I don't expect any of that will change. But it's one of those things we say often. It's like, look, guys, there is a huge opportunity here. The volatility compensates you for the leverage that you're taking over in this market. And so your allocation is a lot smaller, but your return profiles are probably the same at the end of it on a dollar for dollar basis. So it's a hard one to answer. It's so unique to every single person.
The Sydney property questions, was always a fun one to talk about. Right?
It's always difficult.
I mean, it's the greatest big city in the world, in my opinion. And when I came here in 2009, initially, I thought it was expensive, like pretty, just coming from the U.S. and it seemed quite expensive, and I was, it's only gotten extremely more and more expensive. But when you look around, and that's all for people that are already in the market. And by the way, same things happened in Europe, same things happened, or in the UK at least, same things happened in America and Canada. Like boomers and I guess people in their 50s rode ZERP higher and higher and higher, and got bailed out at every turn. Like 2008, there probably should have been a proper crash, and there wasn't because money was thrown from helicopters. But it's about the 25 or 30-year-old, or even my kids are sub 10. Why are people moving to Newcastle or Wollongong or Orange or Sunshine Coast or wherever? Well, it's pretty obvious because, like to Luke's point, you used to be able to go to Kellyville. Now you gotta drive, did you want to buy the size of the room, and they're on top of each other, and trust me, if you have 3 kids, it's hard to you pull your hair out. And so, yeah, I just don't. It'll be really interesting to see what the demographics look like in Sydney over time. It's a totally separate conversation. But for that person who's 25, 30, should they be allocating 10, 15, 20% to digital assets? A, because they're probably more native digital asset users, or they may just be using them in their daily lives and generating things from digital assets. So, yeah, so we're obviously an accredited fund, so it's going to be a little bit of different. Yeah. So most of the investors that we speak with probably put anywhere between 1% to 5% of their overall net wealth into the fund.
Yeah.
But even so Sydney is a very unique example, right? You have title, you have really good properties to buy. Go to any other country, right, and make the same case. Like, should people put money in their property portfolio or digital assets? And I think that risk reward becomes infinitely different. There's probably not a lot of equity built into a lot of people's globally house. I mean, in America, just recently, they've got some equity built in, but what are they using? They're not running overdrafts like they are here in Australia. Like most people have an overdraft and they'll sit there and they'll actually fund a lot of their lifestyle that way. I don't know. I mean, it becomes very easy to see in US dollar terms. And this is the other thing, which is Australian property's been horrible in US dollar terms. So not horrible, but not as good as people think. It feels great selling a place for 5 million Aussie, and then you realize it's 3 million US. And most of your gains have come from a currency FX sort of rate that continues to drip low. So, it's similar if you go into Southeast Asia or if you go through most of Europe. Like, property prices are really heavily impacted by your local currency that you're measuring that price in. And I think, one of the things we're seeing in the States as they continue to add more debt to the balance sheet is a dollar isn't worth what a dollar used to be. And so you hear this number and you feel great about having an extra $3 million in your pocket, theoretically, as an equity value. But then you go and use that for something, and the S&P is at 5,000 and change. The house over the road's $3.5 million. It's not like you've actually added any value through time, right? You're just keeping up with the depreciation for your currencies is really what you're doing there, and you're doing it at 10 times leverage is the benefit.
Sound like a Bitcoiner.
I was going to say that leads right back into Bitcoin argument, doesn't it? Yeah, John, we've got. I think our camera is going to run battery if we don't wrap it up. But we do need some closing thoughts, and of course we need to know how to get in touch. Yeah. So, closing thoughts. I guess that's the thing here. So this cycle, where do we get to? What's
this cycle? It's a good question. So it depends. It depends a lot on the Fed. If China actually starts to stimulate and can bring itself out of the hole it's in, the Fed has to keep rates higher here, and it's going to put a real cap on the cycle, I think, my view. If China implodes and it can't keep itself, it's going to export deflation. That's going to show up globally, and you are going to have a Fed that goes from 5 and change to 2 and change, and we're going to have one of the biggest cycles we've ever seen. I don't know. I'm just going to watch and see.
Yeah, right.
I'm going to say the Bitcoin bid stays live and it plays out like previous cycles, and we've got a lot of upside from here. I'll let Luke take the macro. I'll take the crypto approach.
Very good. Yeah. And how do people get in touch with you guys?
VCARA.com. Best place, luke.mcfarlane@vikara.com. Just send me an email, or mark.riccio.
Yeah, go to our LinkedIn. So we actually send, if people are interested, we send out our investor monthly. We don't have to send just to our investors. And if you're interested, generally it's macro and then crypto. And then we have historically put tokens in. We took them out, but we put tokens in again. And people seem to like the token ideas. So feel free to just hit us up and we'll add you to the list. It's a good way to kind of observe what we're doing.
Yeah, with your newsletter, I always read your newsletter, and one thing I like about it is that for a non-economist, you guys write you put concepts really in an interesting, fun way to read for a non-economist, which is actually worth checking out. So
appreciate that.
Give that a plug.
And we like to have a little dig at Hours at B every month, especially the Washington D.C. folks, if we can.
That's true.
It's my American roots. You got to.
So, who is it? A joint effort, or who do you write different bits, or who's is one?
Yeah, I usually write the macro part, and Mike writes the token part.
And crypto and token, digital asset and tokens part. Yeah, we just split it up, and we divide and conquer. But yeah, no, we pretty much we share token ideas, and we both do a lot of analysis and digging, and as you know, there's a lot of hidden gems in various parts of here, right? It's totally different from traditional markets, and that's the fun of it and the opportunity.
Yeah, absolutely. Yeah. All right, I guess we have to wrap it up there. Thanks, Nick.
Cool. Thanks, guys.
Independent Reserve, the trusted cryptocurrency exchange.